Did you know that 8 out of 10 new businesses crash and burn within their first 18 months? What's the culprit? Poor financial decisions. But here's the kicker, it doesn't have to be this way. Today, we're diving into the game changing world of capital budgeting and how it can save your business from becoming another statistic. We're about to unpack the secret sauce of smart investing decisions and capital budgeting. Whether you're running a startup or a Fortune 500 company, mastering the skill is your ticket to long term success and financial stability. Are you ready to level up your business game? That's right, today I'll take you to capital budgeting, how to make smart investment decisions. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the ThriveWise love to help more people thrive wisely. Now, let's begin. Alright, I'll be honest with you here. Making capital budgeting decisions is almost like navigating a minefield blindfolded. You've got to evaluate risks that could blow up on your face, calculate potential returns that might never materialize, and somehow predict the long-term impact of it on your business. It's enough to make even the most seasoned CEOs break out in a cold sweat. First up, there's the risk factor. How do you accurately assess the potential pitfalls of a major investment? It's not like you've got a crystal ball, right? Then there's the return on investment. Sure, those projections look great on paper, but will they actually pan out in the real world? And let's not forget about the long-term impact. An investment that looks golden today could turn into a major headache down the road. How do you balance short-term gains with long-term sustainability? To top it all off, you're dealing with limited resources. Every dollar you invest in one project is a dollar you can't use elsewhere. Talk about pressure. And in today's fast-paced business world, you need to make these high-stakes decisions quickly, often with incomplete information. It's a lot to juggle, right? But don't worry. We're about to break it all down and show you how to become a capital budgeting ninja. Let's start with the big kahuna of challenges, risk assessment. Imagine you're a tightrope walker, and each investment is a different rope. Some are thick and sturdy, while others are as thin as dental floss. Your job? Figure out which rope won't snap under pressure. Fun, right? Here's the kicker. In business, you can't just poke the rope with a stick. You've got to use fancy tools like sensitivity analysis and Monte Carlo simulations. Sounds like a Vegas casino, doesn't it? Well, in a way it is. You're betting on the future of your company. Let's break it down with a real-world example. Remember when Blockbuster decided not to buy Netflix for a measly $50 million back in 2000? Talk about a risk assessment fail. They thought, nah, this whole streaming thing is just a fad. Fast forward to today, and Netflix is worth more than $150 billion. While Blockbuster is, well, let's just say they're not exactly bustling blocks anymore. Now let's talk returns. Calculating ROI or return on investment is like trying to count jelly beans in a jar from across the room with your eyes closed and while also riding a unicycle. You've got to factor in everything from market trends to potential tech disruptions. It's enough to make your head spin faster than a fidget spinner on Red Bull. Take Amazon for instance. When Jeff Bezos decided to invest in cloud computing back in 2006, many thought he was off his rocker. An online bookstore doing what now? But Bezos saw the potential returns that others missed. Today, Amazon Web Services generates over $40 billion in annual revenue. That's a lot of jelly beans. But here's the thing about returns. They're not always financial. Sometimes the return is in brand value, customer loyalty, or even employee satisfaction. It's like planting a tree. You might not get apples right away, but you're creating shade for the future. Speaking of the future, let's dive into the long-term impact of capital budgeting decisions. This is where things get really tricky. It's like playing chess, but the board keeps changing and half of your pieces are invisible. Consider Kodak. They actually invented a digital camera in 1975 but decided not to develop it, fearing it would cannibalize their film business. Fast forward a few decades, and well, when was the last time you bought a roll of film? That's a textbook example of failing to consider long term impact. On the flip side, look at Toyota's investment in hybrid technology. When they launched the Prius in 1997, it was a huge gamble. Gas was cheap, and nobody was talking about carbon footprints. But Toyota played the long game, and it paid off big time. They've sold over 15 million hybrid vehicles to date and established themselves as leaders in eco-friendly transportation. Now, how about we talk about a challenge that keeps many CFOs up at night? Limited resources. It's like being a kid in a candy store with only $1 in your pocket. You've got to choose wisely, because every Snickers bar you buy means you can't get that Twizzler. In business terms, it's called opportunity cost. Every dollar you invest in Project A is $1 you can't invest in Project B. And let me tell you, FOMO, or the fear of missing out, is real in the corporate world too. Take Google for example. They're known for their 20% time policy, where employees can spend 1 day a week working on side projects. Sounds crazy, right? That's a whole day of productivity, quote unquote, lost. But this policy has led to the creation of Gmail, Google Maps, and AdSense, some of Google's most successful products. Talk about turning the fear of missing out into the joy of missing out. Now let's address the elephant in the room. Or should I say the ticking time bomb? I'm talking about the need to make quick decisions with incomplete information. It's like being on a game show where the questions keep changing. The buzzer is always about to go off, and half the letters on your answer board are missing. In today's fast-paced business world, waiting for perfect information is like waiting for a politician to give a straight answer. It's probably not gonna happen. You've got to make decisions fast, or risk missing out on opportunities. Take Uber for instance. When they launched in 2009, they didn't have years of market research on the ride-sharing economy. They saw a problem, which is it's hard to get a taxi, came up with a solution, which is let's use smartphones to connect drivers and riders, and jumped in head first. Was it risky? You bet. But sometimes the biggest risk is not taking any risk at all. Now, I know what you're thinking. This all sounds great, but how do I exactly make these decisions? Well, that's where the magic of capital budgeting techniques come in. It's like having a financial Swiss Army knife in your pocket. You've got your net present value, or NPV, which is like a time machine for money. It tells you what future cash flows are worth today. Then, there's internal rate of return, or IRR, the overachiever of the financial world. It's always trying to find the highest possible return. Don't forget about payback period, the impatient cousin who's always asking, are we there yet? It wants to know how quickly you'll get your money back. And let's not overlook real options analysis, the creative thinker of the bunch. It's always looking for hidden opportunities and flexibility in your investments. All of these tools are here to help you make more informed financial decisions. If that's not enough to convince you, here's the plot twist that will for sure blow your mind. Numbers aren't everything in capital budgeting. While quantitative data is crucial, ignoring qualitative factors is like trying to bake a cake with just flour. You need the eggs, the sugar, and that secret ingredient, which is love, obviously, to truly make it delicious. Consider Apple's decision to invest in its retail stores. On paper, it looked risky because of high costs, fierce competition, and uncertain returns. But qualitatively, it was genius. It created a unique brand experience, provided excellent customer service, and boosted overall brand loyalty. you can't put a number on the magic of holding an iPhone before buying it. So next time you're crunching those numbers, take a step back. Ask yourself, how does this align with our company's values? Will it boost employee morale? Could it give us a competitive edge? Remember, in the grand chess game of business, sometimes the most powerful moves aren't just about capturing pieces, but positioning yourself for long-term success. Basically, smart investment decisions are your business's secret weapon. Use capital budgeting tools wisely, but don't forget the qualitative factors. Balance short-term gains with long-term impact, and remember, every investment decision is a brushstroke on your company's masterpiece. So, make it count. Also, what's your take? Is it better to make a fast decision with incomplete information or wait for more data and risk missing an opportunity? Share your experiences and let's debate in the comments below. Well, that's basically capital budgeting, how to make smart investment decisions. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.